Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Morning everyone, it's DJ here and welcome to another edition of the Weekly FX Navigator. As regular listeners would know, we focus on one or two major developments within currency markets each week. In this episode, which is being recorded on a gloomy, rainy morning in Singapore, we are looking at things from a bigger picture, starting with the underlying message out of the recently concluded Jackson Hole Symposium and how that impacts our views around the dollar. So investor attention has been centered on this event given recent talk of the Fed tapering its asset purchases. Ahead of the symposium last week, currency markets were expecting Fed Chair Powell to adopt a dovish tone with the dollar selling off. The chairman sounded a note of caution about employment levels and continued to stick to the central bank's script that the current bout of inflation will likely be transitory. His reassurance that any tapering would be gradual and that the Fed is not in a rush to hike policy rates helped prop up risk sentiment amid increasingly hawkish views among some policymakers to expedite tapering. Price action also likely reflected the unwinding of recent long dollar positions built up in anticipation of this event. While the dollar could drip lower over the next few days, we note CFTC positioning indicates that leveraged investors have only recently unwound their short dollar positions. Other headwinds include a COVID-19 resurgence, especially given recent headlines around the strain on US hospitals and commodity price pullbacks. What that means is that dollar resilience could still persist over the next 1 to 3 months. Key events such as the OPEC Plus meeting and US non-farm payrolls are some data points to keep an eye out for this week. That sums up our range-bound outlook for the dollar over the next 1 to 3 months. It is valid to question if Fed tapering implies further dollar gains via higher bond yields from here. However, the still wide disconnect between relative inflation-adjusted differentials and the dollar, combined with the dollar index approaching key resistance at around 94 to 95, tilts the balance in favor of a weaker dollar over the next 6 to 12 months. On that note, this brings us to the end of this week's episode. If these FX tidbits have caught your interest and you're keen on reading some of our publications, you should head over to sc.com and look for the tab titled Latest Market Insights. If you're a valued client of Standard Chartered, please reach out to your relationship manager for more details. Thank you for taking the time to tune in and enjoy the rest of your week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.